Welcome to the best of Candid Coffee from RIA Advisors. Today's episode offers the best advice for investing, saving, and protecting your money from Richard Rosso and Danny Ratliff, plus Lance Roberts' mid-year investment review. Now, wearing their Saturday morning best, here are Ratliff and Rosso and Roberts.
Hey, good morning, guys. Thanks for joining us for this next edition of our Candid Coffee here with Lance Roberts. So lots of market volatility here recent weeks. Want to get into a little bit of discussion about what the Fed's next steps may be, where we may be heading this summer, obviously in this great recovery from the pandemic. So lots to get into. If you have any questions, please go to the Q&A or the chat box. We'll be happy to answer questions along the way. We did get quite a few ahead of time. We're also talking a little bit about some of the best accounts for you guys to put some funds into. When Rich gets logged on here in just a bit, we will do that as well. But Lance, I know you have some charts prepared.
Of course, I always have charts prepared. So, that's an easy thing to get into. So very quickly, good morning, everybody. Glad you could join us here for a few minutes. I'm not going to take very long. I want to get right into your questions really here fairly quickly. So, let's start with kind of just where we are right now. There's a couple of important topics to kind of touch on to, which is particularly valuations, where we are, a lot of concerns about inflation. Is that going to lead to hyperinflation? And there's some issues that really surround that. So we're going to talk into that. So let me jump through a few charts here real quick. And first, let's correct a misnomer that March of 2020 was a bear market. March of 2020 was not a bear market. It was a correction. There are several defining factors of a bear market that make a bear market valuable in terms of a long-term return. One, it reduces valuations back to long-term means. The second thing is that it also gets rid of investor exuberance. And the one thing we didn't see after the correction in March of 2020 was a elimination of investor exuberance. In fact, investors came charging back into the markets, because of the Fed and because of liquidity, even faster than any other point we've seen in history. After a real bear market, like we saw in 2009, investors don't come back for years. In fact, a lot of investors that are getting into the market today have been out since 2009 and have really and now think that they've missed it. Now they've got to get in. And that's very typical of a late stage bull market cycle. So, also too, as you see in the chart, we never broke the long-term bullish trend. One of the defining characteristics of a bear market is that you break the previous prevailing bullish trend of prices, and we never did that. Second thing here, of course, is also looking at total returns going forward. If you take a look at any of the vast measures of valuations, take a look at things like market cap to GDP, which is now trading at 2 times the rate of market cap to GDP ever before in history. Tobin's Q is at an all-time high. Price to trailing 10 years earnings, what we call CAPE, that's trading at the second highest level valuation on record. No matter price to sales, all-time record in terms of valuations of what you're paying for stocks and revenue right now. All 4 of those measures, which have a long-term historical correlation of markets going back to 1870, suggest that over the next 10 years, you're going to have a rate of return nearly close to zero, if not negative, over the next 10 years. Does that mean every year is going to be that? Absolutely not. What that means, of course, is over the next 10 to 20 years, you're going to have 1 or 2 major bear market declines that'll wipe out a lot of the previous returns, and you'll spend a few years getting back to even. Hence, your total return are going to be near zero. Same thing you saw between 2000 and 2013. Same type of transactional process in markets as well. 7-year asset class real returns. If you don't believe me, here's GMO, which is well regarded on Wall Street. 7-year returns on stocks over the next 7 years expected to be negative. Same reason, valuations. Yields are certainly a concern. A lot of people expect right now that, hey, yields are going to go up to much higher levels because of this booming economy that we have. Well, the problem is you have to separate out the difference between a stimulus-led recovery in the markets and an economic growth market, which is one that's based on organic growth, wages, productivity, those type of things. We have the former, not the latter. And with the amount of debt that we have in the system, whether it's government debt now approaching $29 trillion, or household debt, or corporate debt at an all-time record, margin debt at all-time records, housing debt pushing up, housing prices near bubble levels. No matter how you look at the market, the economy, et cetera, it's all about the leverage. And as those interest rates rise, you're going to impact the leverage of the market fairly quickly. And throughout history, it doesn't take much of an increase to impact debt. And those increases in interest rates are getting smaller and smaller over time. But here's another thing that yields tell you about the economy. What yields tell you about the economy are two things. One, if you take a look at the ratio between stocks and bonds, they've been highly correlated. They are the most highly correlated right now since the dot-com crisis. But when the stock bond ratio reaches a record like it is today, typically that precedes bigger corrections in markets over time and a reduction in valuations because of the deviation between stock prices and bond prices. Now, why is that important? Well, that's because bonds tell you a lot about the economy. Over the last decade, because of what's been happening with all of the financial interventions by the Federal Reserve, we've been pulling forward revenue and sales and earnings for companies, but yet the economy has not really been growing. We've been pulling forward those sales, which means that we leave a void in the future that we have to keep refilling every time with more stimulus, more liquidity. If you take a look at the recent retail sales numbers, the stimulus that we had from the last, several checks mailed to households pulled forward 5 years worth of retail sales growth for retailers. So what's going to happen next? What's going to fill those sales that now people have all spent their money on? What's going to keep those sales going in the future? This is the problem with inorganic activity. And there's a huge correlation between interest rates and our economic composite, which is basically wages, economic growth, and inflation. You cannot have, and have not had, with the amount of debt in the system, stronger growth, stronger inflation, stronger metrics across the board, particularly in wages, which is a cost to businesses. You cannot have increases in those without impacting the overall economic activity. And in fact, what rates tell us right now is that over the next 10 years, that economic growth is going to be somewhere between 0 and 1.5%. That's what rates tell you. And the long-term correlation, and this correlation is very high, there's a 75% correlation between interest rates and the economic composite, tells you that the economic bounce that we're getting now won't last very long once we get to next year. And of course, the deviation in the markets is also a concern. Whenever markets get extremely deviated from long-term moving averages, and remember, in order to have an average, the reason averages are important, in order to have an average, prices have to trade above and below that price level over a period of time. It has to be on both sides. That's how you get an average. And every time we've had deviations of more than 20% from those averages, we've had a reversion to that average over time, whether it was a mean reverting return to that average, in other words, it went below it or at least came back to it. We now have the highest level of deviation on record of the S&P going back in history with the bottom part of that chart is the relative strength index. You'll also notice that every time it hits the green on the top, you start getting close to the point of the end of a bull market cycle. Does that mean tomorrow? Absolutely not. This is a monthly chart. It could be a year from now before we eventually see a reversion. But what this is all telling you is that we're getting to the point to where upside potential in markets is beginning to really outweigh the risk that you're taking to try to capture returns. Let me stop there. And again, quick overview, and let me turn it back over to Danny, and we'll answer some questions.
Well, thanks, Lance. I think that's really good. And I know that probably answered a lot of the questions that people have right now. We did get quite a few. Just a reminder, go to the Q&A box. If you're looking at the screen, it should be towards the bottom. If you hover your mouse, you'll be able to see it there. There's also a chat box. We'll be answering both. So we do monitor those throughout. No question is a bad question. We hear them all. So we'd love to hear and address any issues you have. We're going to try to get to all of them. If we can't, we'll try to follow up either on the show or individually afterwards. So Lance, you mentioned a lot of things. And one of the things that just stuck out to me is when you finished was that markets were, there's a lot more risk in the near term. Right. So risk reward scenarios are beginning to shift. And I'll tell you, we got a ton of questions in, and several of them are the same. Many of it has to do with somebody who's been out of the market since 2008 or 9, trying to get back in. How do you navigate that, right? And I feel like we always hear this quite a bit, especially when we see these markets that have ran like they have. What would you say to somebody who just needs to dip their toes back into the water?
Well, the problem with having been out for the last few years and now trying to get back in, this is exactly what I was talking about. This is about psychology. See, a real bear market, that is a telltale sign of a real bear market. Hey, I can't afford to lose 50% of my money again. But after a decade now of market prices going up, now there's this psychological pull that, oh, I've got to get in. I'm missing out. I've got to get my money in. And look, I don't disagree with you. How long this market can continue to go higher is absolutely a very, we don't know. I mean, it's just, there's so many things. There's so much Fed intervention, so much monetary liquidity. Prices can certainly go higher. So you have to start working your way back into the market slowly. This is what we do with our clients as well at our shop is, when you show up with a bunch of cash, we start easing you into our model. We look for dips in the markets where we get a buy signal like we got this past week. So we start adding a little bit of exposure in and slowly kind of stair step into the markets. Now, you have to understand that if you, even in this process of where we are in the markets, is that you may get in now and then have to turn right around and get back out next year or in a quarter or in half a year. Whenever the market begins to turn, it's going to turn. It's just a function of time. And, the way to start knowing that clock is ticked is when the Fed actually hikes the interest rates the first time. Is that this year? Is it next year? But as soon as they start hiking rates, that very first rate hike starts a timer of about 9 to 15 months before the next correction in the market occurs.
Now you're talking about a more significant correction similar to a bear market, not just a normal run-of-the-mill correction, 5 to 10%, right?
Well, no, we're going to have a 5 to 10% correction probably sometime this summer. In fact, we've had the longest advance in the market really about the last 20 years without a 5% correction. Those are completely normal. Those are buying opportunities. Yeah. I'm talking about a 30 to 35 to 40% correction of the markets when the Fed starts hiking rates and of course, reducing liquidity. They're always late. And the reason they're always late is because they read the wrong economic indicators. That, again, what are they looking for right now? This massive economic rebound, which they think is an actual recovery. But this is simply just a stimulus-led rebound back to where we were previously. And now with the stimulus fading, you've got issues with the dollar coming up. We'll talk. We just got a question come in about the dollar, and that's a great point to talk about. But the dollar is a real issue here going forward for the markets over the course of the next few years.
Okay, so Rich, I can turn this to you now in the sense of, talking to somebody, you're on the front lines, who's been out of the market, needs to get in. I know where you and I would typically go with this is they need a financial plan, right? You need to stress the funds and understand that markets can be irrational, probably longer than we can be rational. But if you want to start getting in, we need to understand the risk and what that impact is to your well-being, right?
Well, to Lance's point, one of the things that we've done at RIA is adjust forward-looking returns for every asset class in a financial plan. So when you go to a brokerage firm and you do a financial plan, it's great, but they're going to use historical returns. Market always gives you 10%. Everything's fine. We don't do it that way. We have a realistic approach based on valuations. So when we get you the results, it's going to look a lot different. So what we would say to you is, well, for all the risk you're taking, you may not get the return. To Lance's point, I'm hoping the forward returns aren't as dire as he's indicating, but obviously the numbers are the numbers. And if you're going to be in retirement and distributing assets from your account, you're going to have to watch every step. So I would tell people that are just doing this, and now after a decade plus wanting to get in, you really know why. Why are you getting in? Why? The why is the plan, right? Why am I getting in? Because my neighbor's in? That's not a good enough reason. I need to look at the goals I have, how much risk I need to take. Maybe I've done such a good job saving my money that I only need a 2%, 3% return to get to my goals because I live reasonably. So if your goal is I got to get in the market because they haven't been in, it's not a goal. That's just you feeling pressure from Joe at the cocktail party. Are we doing those again? So you want the plan first. And to Lance's point, which is great, you start slow, take your time with it. maybe it's 5% into the market or so. You may not emotionally be prepared. You know, it's like taking me right now and putting me in boot camp for the Army, okay? I mean, I'm going to be like, what? That's what it's like. You're in a whole new terrain because you've been out of the market so long. And the first downturn, Lance brought up 5 to 10% is the price of admittance. That first 5% move, guess what you're going to do? You're not going to add to it. You're going to take it away. And you're going to be stuck into the same pattern.
Yep. So kind of switch gears just a tad bit. So Lance, going back to that chart you had from GMO, Jeremy Grantham,
right.
You know, widely respected shop, they're estimating returns. I saw -7% for the next decade. Now explain what that means though, because I think a lot of us look at that and people think, okay, well, we're going to have -7% every year, or what does that look like? That could just mean we have a market correction. It takes a while to get back to even, correct?
Right. No, and actually, if you go to our website, realinvestmentadvice.com, and just put into the search bar as an example, put in low returns. And I wrote an article about 3 weeks ago talking specifically about this, is why low returns is what we're talking about here. And no matter what valuation measure you use, they all tell you that basically returns over the next 10 to 20 years will be low. And the reason for that is because of what you're paying today. As Warren Buffett once said, price is what you pay, value is what you get. And value matters ultimately at the end of the day. If you overpay for a house, a great survey out over the weekend, 63% of millennials that ran out and bought a house over the course of last year now regret it because nobody told them about the maintenance cost. So it's not such a big deal, right? And when you overpay it, now you go, wow, now I got to get out of it. Now I can't sell it because I overpaid for it. That's the problem with overpaying for anything, is that ultimately your future valuation is lower. But does that mean every year is going to be zero? Why invest for 20 years if I'm going to make zero of my money every year? No, that's not what it means. What it means is you're going to have 10% return one year, 10% return the next year, 10% return the next year. You're doing awesome. You feel great. Then you have a 40% correction. Then you spend the next 6 years getting back to even, and you go, wow, a decade later, I'm back to even. My return was zero. And I'm feeling great, right? Well, that's what happened to investors that were investing in the market in 1999, 2000. They were expecting markets to go up. 13 years later, they finally got back to even. And that's an important thing to understand about that. And I just wrote an article. It's on our website now. I just posted it yesterday. It's called Why Crashes Matter. And crashes matter because if you spend 13 years of your time horizon getting back to even, well, that's 13 years of your time horizon you don't get back. Yes, the media will tell you you always can get your money back in the markets. Yes, if you hold for 30, 40 years, you're going to make money in the markets. There's very little doubt about that because of inflation. But if you spend 10 years of your 20-year time horizon getting to even, you're not going to make your goals. And that's why crashes actually matter. And really the whole premise of how we manage money is capital preservation, because reducing your losses, and you're going to have losses. You can't invest without having a loss. But if you can reduce those losses, you spend less time getting back to even and more time making money towards your goals. And minimizing losses is more important than actually capturing upside gains in the markets. If you can reduce the former, the latter becomes a whole lot easier to make out for your plan.
It's interesting. We talked to so many different people, and a lot of people actually never fully experienced a bear market in the sense of having to take distributions from portfolios. A lot of people have used it to their advantage because they've continued to contribute to the 401k. They've put funds aside into the markets, and it becomes a game changer once we start taking distributions. You mentioned a very long time to get back to even, which we know, 2000 to 2010 and beyond, we call it the lost decade because of the way the market worked, right? I mean, 2 recessions in a period of time. We could see that in the future. And so I think this is something everybody needs to be very mindful of moving forward, especially if she's going to start relying on assets when you get in distribution mode. So Lance, lots of questions about the dollar.
Right.
Everybody's been on one side of the boat all year long that the dollar is going to crash. It's going down. We've actually seen it, gain strength. Now we're seeing a little bit of weakness in it.
Yeah.
What's the expectation here moving forward?
So look, a couple of things. First of all, the approach that our government has taken towards solving the economy, right, trying to fix the economy, was the wrong approach. And yes, and let me clarify before everybody jumps off a cliff and yells at me, just hold on a second, let me explain. Okay. The reason it's the wrong approach is that we keep thinking that every correction or event in the market, we have to bail it out. And capitalism as a function is a very predatory system. In other words, it's very Darwinistic, and it is the strong survive and the weak perish. And that's the way capitalism is supposed to work. We have eliminated that since 2008 by trying to bail out companies, bail out banks. Companies spend years buying back stocks, and as soon as they get in trouble in 2020, they run to the government for a bailout. And so the government says, okay, well, here's more money. And we don't allow the process of capitalism to work. Now, what does this have to do with the dollar? Bear with me 1 second, I'll get there. The point is that the reason people invest in the US and the reason that the US is a reserve currency is for three reasons. The first reason is that the breadth and depth of the dollar is one of the largest currencies in the world. So we can handle billions and trillions of dollars of transactions on a daily basis without moving the currency all over the place. It's a supply-demand issue relative to the currency. What's important about transactions is that if I'm a seller of a product in Zimbabwe to the US, I can't have the dollar moving up or down 30% in a day, because I can't, as a producer or a manufacturer or a buyer, I can't hedge that type of volatility risk. This is why cryptocurrency right now cannot be, and it cannot take the place of the dollar, because you can't have a currency flying all over the place every day in terms of volatility. It's a great trading vehicle. You can make some money with it, but it can't be a currency when it's moving 10, 20, 30% in a day. The second reason people use the dollar is what's called the rule of law. What people depend on is that there is recourse for transactions. And in the US, we have a legal system that suggests, anyway, on the surface, that you have recourse. So if somebody doesn't honor their contract in terms of a transaction, you have recourse in the courts, and you can protect your investment that way. So rule of law is very important. We have done a very good job over the last 3 administrations of eroding that rule of law by changing the rules to mortgage contracts, changing the rules to corporate contracts, doing a lot of things that we've done to undermine that whole aspect of rule of law. Shame on Congress for the things that they've done, and the Federal Reserve over the last decade. It has made America weaker, not stronger. The third thing that people rely on in terms of the dollar is not only just the rule of law and also the depth of the currency, but it's also the psychology of the economy. If I'm a person doing business in US dollars, I want to make sure that economy that I'm moving money around in is strong, and it is stable, and it is a function of growth over time. Eroding the underlying capitalistic system and moving us more towards a socialistic system undermines that psychology of economic strength. So if you want to destroy the US, which the Fed and our Congress is continuing to do a really good job of, continue to undermine that psychology of strength of the US economy, because people understand that what is going on with the dollar. And this is why cryptocurrency is a thing, right? It wouldn't be a thing if you weren't undermining that social psychology of economic strength in the US. So what do we need to do to fix it? One, recessions are not a bad thing. They're a good thing. Are they painful? Yes. People are going to be foreclosed on. They're going to have to get out of houses they couldn't afford. You know what happens though? It allows them to reset themselves. They file bankruptcy, they clean up their debts, they start over, they get a fresh lease on life. By not allowing that system to work, we keep people locked into their debts, into their struggles, and into their poverty situation. So we actually make it worse for them by bailing them out. Companies that we continue to bail out, there is about 30% of the Russell 2000 index, which are called zombie companies. They are dependent upon low interest rates and being able to issue debt at low rates in order just to finance themselves to stay alive. That's a detriment to the overall economic strength. By allowing them to survive, by bailing them out over and over, they displace opportunity of capitalistic system and entrepreneurs to come in and create new businesses that would be viable and profitable and create employment. So everything that we're doing is actually undermining the very value and base of the capitalistic system and the strength of the dollar. So that's why there's concerns about weakness of the dollar going forward. That is very much the case. But for now, at least, we maintain that reserve currency status. And so this economic recovery we're going to get a short-term lift in the dollar. That's probably going to give us a boost. But as soon as the economy begins to return back to that 2% growth rate next year, and really sub 2% now, that dollar weakness is going to continue.
Okay, that makes sense. So Lance, you touched on a couple of things, and Rich, I want you to answer this one here. So did get some questions about, and we initially dubbed this as we were going to talk about where to hold assets. What are the best accounts? And we had a handful of questions, particularly about investing in IRAs and what types of assets you should hold. And so we had a couple come in about investing real estate inside of an IRA. How do you feel about that? Rich.
I'm sorry, I'm having a dog issue here when people drive by. It's like, protect the owner, even though there's no threat.
That's why you have like 26 of them.
I'm working on it. So here's the thing. You can have a self-directed IRA outside of, say, Fidelity and all the other companies that provide them, TD Ameritrade, and hold assets. You can hold promissory notes, you can hold real estate, you can hold precious metals, and whatever you want. You just have to realize that, one, these investments are not liquid. There are additional fees to these custodial IRAs and paperwork that needs to be filed. In other words, sometimes they're a pain in the neck. So if that's the only asset you have, to own real estate, and I'm not talking residential real estate, can't do that, but you're going to go ahead and be an investor, you certainly can do that. I would always be careful of the liquidity factor, fees. You know, do I understand real estate? The one thing I stink at is real estate. And the one thing, and Lance knows this, right? Once I make a real estate purchase, unless I pay cash for it and I can sit on it, unlike a stock where I could just sell it if I make a mistake, I could be sitting on an albatross for a very long period of time. So I think the bigger question is, yes, you can do it. How much of it are you able to handle it? What if you make a mistake, especially with the way real estate looks today? Are you overpaying for it? When you say, Lance, I mean, this is the big dilemma now with real estate and the stories we're reading about what people are doing in primary residences. And I mean, everything is distorted in price today. Well, everything.
As you know, I invest in real estate too, and I do hard money lending for commercial properties, those type of things on a personal basis. Putting real estate inside of an IRA is really a very poor choice. And the reason is that when you put real estate inside of an IRA, you lose all the tax advantages of investing in real estate. Why do I invest in real estate? Well, I can write off all the expenses of maintaining that property. I can increase my profit margin of that business because that's what it is. It is a business because you're investing in another, a project here. But you lose all those tax advantages of investing in real estate would actually hurt your return long time, even though you're technically deferring your taxes. That's great, but you're losing all the benefits of actually owning real estate inside of an IRA. So if you're worried about, legal issues in terms of somebody falls and breaks their leg on the front porch and they're going to sue you personally for that because it's your property, then put each individual property inside of its own LLC. That gives you shelter. That gives you some space between you personally and that business. But run it as a business and you'll actually be a lot more profitable long term.
Yeah, I mean, that's a good point, Lance.
The one thing you have to keep in mind, to Lance's point, you're going to lose the depreciation, all of this stuff. There are some firms in town that you can be part of. They're on radio shows and all that. They will tell you, liquidate your IRA. Take the pain. Because longer term, you're better off owning the real estate outside.
Yep.
So Lance brought some very good points about losing the deductions. I would rather own, for example, promissory notes or maybe even precious metals inside an IRA over real estate. I would leave real estate absolutely out of the equation. But there's some people that's where all the Lance, how many times, Danny, we talk about this? Most people's wealth is locked up in tax deferred accounts, which actually prevents the flexibility in so many things, because that's what mainstream financial industry promotes and which we have moved away from for so many years, right?
Yeah.
Absolutely. So before we get on to our next question, we are going to give away a Candid Coffee mug. So Steve Huning, expect a mug in the mail here soon. We're going to give away a couple more throughout the show, so stay tuned. You may be next. Rich, talking about other accounts, what is your favorite account right now that you can put money into?
My favorite?
Yes, your favorite.
My favorite is anything is a 4-letter word. That's my favorite. Roth 401k, Roth IRA, anything with Hyman Roth from The Godfather. Anything with Roth is better than anything else.
Wait a second. I've got one better.
I do too.
Hey, look. No.
For me, it's whole life insurance. For me, it's overfunding a whole life insurance policy, tax-free growth,
permanent,
and it's permanent. Absolutely,
a permanent.
I love that too.
And plus, I get a death benefit. And look, and when my wife kills me off, I get a death benefit on top of it. So she's even better off.
Wait a second, you don't get that death benefit. She gets it.
Well, that's what I'm saying.
Yeah, there is a.
You know, it's weird. She does call me like twice a year. Like, Danny, do you remember what that is?
Exactly.
Yeah. So the point is, to Lance's point and to Danny's, there's a whole other world of investing outside of pre-tax. We call it diversification of accounts. Roth is my favorite because, again, life insurance is a little more complicated. You might need more cash flow to do it, but permanent life insurance is awesome, depending on your needs as well. So, but I would say if we're going to look at the best type of accounts for retirement, Roth 401k and Roth IRA. And guess what, Danny? We've been ahead of the curve. How much is mainstream? Rick Edelman, right? Rick Edelman talks about now Roth. Susie Orman, right, got out of her mansion to talk about Roth, and then she ran back into her mansion. So it's all about Roth now, which makes me wonder if it's still right, because of the onerous tax implications we're seeing in the future. And what Danny and I talk about a lot is the implications for Medicare and Social Security taxation and Medicare IRMA charges, which we think will be these backdoor taxes that continue to increase. When you take money out of your Roth, and to Lance's point, policies against permanent life insurance do not count toward those equations of Social Security taxation or additional charges on top of your base Part B Medicare premiums. There's a whole world out there. Get out there. There's a whole world of accounts.
So last account, HSA, right?
Health savings account. Danny, I know this is your favorite. Like, if there was a cliff and you had to save the HSA or Michelle, I'm really not sure which one you'd take. I'm not really sure. The health savings account, right? Yeah, hurry. The health savings account is pre-tax, gross tax deferred, and used for qualified medical expenses tax-free. It is triple tax advantaged. And we tell people what, Danny, hold on to it. It's a retirement 401k. We had a great question on our Medicare Lunch and Learn about flexible spending accounts versus health savings accounts. They're different. Think of it this way. Flexible spending accounts. I need to use the money. Health savings accounts. I can save the money long term. So HSAs, take a look. And if you don't have a high deductible plan at work right now, you will. It's coming. And then last, emergency reserves, right, Danny? We talk about our financial vulnerability cushion, 12 months of living expenses. Online banks like Ally, Marcus. Now, these are FDIC insured. We've been talking about these for 3 to 4 years. Granted, the interest rates 0.5%, but that's better than 0.00001 you're getting on your account at Wells Fargo. So we really, really like. And how many people we have gotten into these online savings accounts? They feel very comfortable with them now. And we do not collect any compensation from any online bank.
Yep.
But we've helped a lot of people with that to at least build their emergency reserves through that.
Yeah, quite a few. So speaking of rates, Lance, one of the big questions that we get in the hot topic is, okay, how do you invest for income at this stage in the cycle? And where are rates going? I mean, everybody keeps calling it they're going to the moon for the last decade. I mean, I was at a big firm in 2011. They sent out a notice to all clients to remind them how bonds worked because rates were going to go sky high. And, we've seen them creep up a bit. And granted, they've been much higher than where they are today. What does that look like?
Well, this is what we're talking about earlier. So yeah, since 2000, back in little history here real quick, back in 2013, Jeff Gundlach and Bill Gross came out and said, interest rates are going to 5%. We wrote an article then and says, nope, they're going to 0. And, and repeatedly over the next several years, there's articles that kept coming out. Interest rates have to go up. Interest rates have to go up because the economy's going and we're growing the economy. And all this was because the Federal Reserve was just stimulating the economy underneath the surface with artificial liquidity, and that doesn't create organic economic growth. So the general consequence is that every time stimulus fades from the system, the economy contracts. So in 2018, the Fed started hiking rates. They tried to taper their balance sheet a bit, and the market fell off a cliff. The economy slowed down. 2020, interest rates hit 0.5%. We were within 0.5% of our 0 mark on interest rates. We're going to 0 ultimately on the 10-year Treasury, if not negative, over the course of the next few years. This is because of the fact of what Congress and what the Fed is doing when they begin to try to hike rates, when they try to begin to taper their balance sheet. That's the whole support for the market. That's suppressing rates. But what is the interesting part about this is that what the Fed does actually works in reverse of what they wanted to do. They're trying to suppress rates. And every time they start QE, it actually causes interest rates to go up. When they stop QE, that's when interest rates go down. There's an inverse correlation between what they say they're trying to do and what actually turns out to be the case. But the consequence ultimately is that rates are going to be somewhere between 2% or less over the next decade. And that's going to vary within that range of between recessions and recoveries. We're going to stay trapped in that lower bound because anytime interest rates get much above that level, you're going to have a slowing down of economic growth. Why? Because people buy payments. They don't buy houses. They don't buy cars. They don't buy anything. They buy payments. If rates go up, I can't afford those payments anymore. So economic consumption contracts and you get slower economic growth. Because again, at the end of the day, if you want stronger growth, you've got to allow the economy to cleanse itself, let the debt cycle reverse. It's going to be painful for a couple of years, but once you get that debt reduced and allow the economy to recover on its own, create organic growth, guess what you're going to get? You're going to get wage growth. You're going to get higher interest rates, which will be good for the economy at that point because that'll be tracking stronger, organic, sustainable economic growth. And you'll get higher rates of inflation, which are also good for the economy long term as the economy grows with it. And again, the thing we're looking at the wrong factor. Everybody's concerned about hyperinflation of the 70s. Interest rates and inflation and economic growth were rising from 1945 to 1968. And they were tracking each other very closely. And we had 8% rates of economic growth, 8% interest rates, and 8% rates of inflation, and 10% savings rates in the economy. Household debt was 60% of debt to income versus 170% today. And guess what? People were buying houses. We were manufacturing stuff. We were growing an economy because it was organic and it was driven by a manufacturing production-based economy as we were rebuilding the entire world post-World War II. We're so worried now about small rates of inflation, we're forgetting the bigger factor that we need to be focusing on the things that make us more competitive, focusing on the jobs of tomorrow and creating the ability to create sustainable economic growth through good, strong fiscal and monetary policies, which have for some reason have completely eluded our leaders in Washington.
Isn't that the truth? Hey, so we're gonna give one more mug away right now. Kyle Holyfield.
Wait, I don't have one. I need one. Can you give it to me?
You don't get one. No. No, you don't get one.
Okay.
So Lance, so where do you go though from an investing standpoint? So we know all these things that are occurring, right?
Right.
And so you just mentioned how rates they're likely to rise, but not as much as what most people think, and then we'll likely see them drop, right?
Right.
So what are you looking for from an investment perspective, especially somebody who needs to generate some income?
Well, you're going to have to be a little bit more creative. And again, this is kind of how we're building our portfolio now, is that we just, as rates approach that 1.8, 1.9, 2% level, start buying some fixed income. You can stretch out your duration a bit. You can probably go 10 to 15 year durations on your bonds, because that's going to be about the peak of interest rates. And so what will happen is interest rates will go from 2 back to 1% eventually. That'll give you a nice capital appreciation in your fixed income, as well as collecting your income stream from the bonds as well. Be very careful. People are chasing high yield. High yield is it's a marketing term from Wall Street. It's junk bonds. Triple C credits. Let me explain what a triple C credit is right now, because triple C interest rates are the lowest level on record in terms of spreads. Triple C credits are one step above default. These are companies that are just about to default on their debt. And people are buying these with reckless abandon because they are under the impression that the Fed is going to bail them out no matter what happens. That may not be the case with a lot of these corporate bonds. When the Fed announced buying corporate bonds and junk bond ETFs back in March of 2020, they bought very little of them. They did not do much of those purchases. So there's a real ability for people to lose a lot of money in bonds. Junk bonds are marketed as high yield because you go, oh, wow, I'm going to get a 5% yield on this bond. Yeah, you are. You're getting paid to take on a tremendous amount of risk. And I would argue that when I do hard money lending, my rates are 10 to 12%, and I've got 70% collateral valuation of the underlying loan. You're buying high yield junk of people that aren't going to pay you back. You have no security, no collateral, and you're getting a 3 to 4% yield on triple C credits right now. You're not being paid for the risk. So, but if rates move up towards the top of this range, you can stretch out your duration in fixed income, but then also look to use opportunities to buy good, strong, dividend growing companies that have a very stable earnings profile. This is we have a portfolio metric we call earnings certain. And these are companies that over the last 30, 40 years have very little variability in earnings. They grind out earnings regardless of a recession or a growth or whatever. I mean, if the economy's booming, they're going to grow 6% earnings. If the economy's in a recession, they're going to grow 5% earnings. They just grow steadily. And what that does is that reduces your volatility risk over time. They have a very low history of cutting dividends, and you have a better ability to create income from portfolio. You will have some volatility, but unfortunately, that's the environment the Fed has put us into now, is that we're going to be forced to take on more risk to create income in a portfolio. It's no longer you can create a 20-80 portfolio of 80% bonds and supplant your living expenses. That's just not available anymore. Even the most conservative investor is going to have to take on risk of 40 to 50% of their portfolio in equities to outpace inflation over time. It can be done safely, but you've got to manage that risk, and you've got to understand what you're doing. People are buying AT&T because here's this company that's going to grow earnings, and they've got this 7% yield. That's awesome. You lose 50% of your money back in March, and now they've cut their dividend in half. So, those theses of I'm just going to buy dividend yielding companies and hold them doesn't work out well if you don't know what you own.
Yeah, that's a very good point, Lance. So Rich, kind of switching gears here again, lots of questions about the Roth IRA and conversions from the IRA to the Roth. And so we briefly touched on that. Lots of implications potentially here in the near future from a tax increase. The administration's been, pretty clear that they're going to raise taxes here in the future. So what would you say to somebody who maybe's out of work, or they may have some opportunities to do some conversions, or maybe you just say, hey, is there an opportunity this year prior to taxes going up to utilize something like this?
Well, and again, we're looking at a new Secure Act that's coming out, at least we think so. That actually, we talked about this on the radio show, that there's an underlying Rothification going on of strategies where the government, like J.G. Wentworth, wants their money now. So Roth is becoming more popular because, and you never know what the government's going to do. We had one suggestion on a viewer sent in about, wouldn't it be great if the government would allow us to do a Roth conversion at a more favored rate just for 1 year? Wow, that is a great idea. Whoever that is needs a mug. I don't know who it is. It's anonymous. So I think that Roth is just going to continue to grow. So the point is, if you're going to be in a lower tax bracket because you left your job, you're going to be working part-time, never let a tax bracket go unused. Convert some money from IRA to Roth as long as you have assets outside to pay taxes. Because you got to remember, what the administration is not telling you, and it's smart, is they're saying, well, we're only going to raise taxes for those who are making, a household income of $400,000. But then what they're not telling you is in 2025 that these current rates for everybody sunset, and in 2026 we're going back to rates that were there pre-Tax Cuts and Jobs Act. So everybody's going to get a marginal tax rate increase. If I was in the 12%, I'm going to be in the 15%. And guess what they could say? We didn't do it. That's not us. That was the other administration. I don't care which administration is in. So taxes are going up for everybody.
Well, and there's another point about taxes. There's two things about taxes. Tax cuts, as opposed to what people are told, do not trickle down in the economy. Tax cuts remain at the top of the ladder, and they translated immediately, as we said, when the Trump administration first passed the tax cut bill. We said this isn't going to trickle down into the economy. What's going to happen is it's going to convert into stock buybacks, which is exactly what happened. So all the repatriation of dollars, all of the tax cuts that were in, all went to stock buybacks. Real quick, side note on stock buybacks. Stock buybacks were illegal until 1980 because they are a form of stock market manipulation. Share buybacks do not and are not a return of capital to shareholders. That is a giant myth. The number one group of people that benefit from share buybacks are corporate insiders who receive stock grants from their company in terms of their stock option compensation. They then use those buybacks to sell their shares and embolden their wealth. That is a study from the Securities and Exchange Commission, mind you, that actually found that out. So the only way you benefit from a share buyback is if you sell your shares. Guess what? You can sell your shares any day you want on the market and get your money out of the company. So a share buyback does you no benefit whatsoever as a shareholder of the company, sitting home owning your 20 shares or 50 shares or 100 shares of Apple. Share buyback does you no benefit. It does benefit insiders of companies, and it is a form of stock market manipulation because this is how companies have been beating earnings for the last decade. Revenue growth for companies since 2007 total has been about 60%. Earnings growth has been over 400% because of stock manipulation and stock buyback. So, but that's where tax cuts go. They don't trickle down. They stay at the upper end of the ladder. You know what trickles down? Tax increases. You increase taxes, that trickles down to everybody in across the country, and tax increases impact the one part of the economy that you're trying to help the most, and those are the poor, because they wind up having to pay a lot more costs for goods and services, and they have no increase in incomes. That's why you're always going to try to have, everybody's trying to bail out the 20% of the population. And the one thing you do by all these measures is you actually make it worse for them because you increase their cost of living across the board, and they don't have wage increases to support it.
This is the point where the Biden administration has the cane with the thing, and they pull Lance out of the screen, but they don't want him talking anymore.
Look,
because
it's basic economics. It's basic economics.
But why aren't they talking about, instead of tax increases, penalizing buybacks or going back to that rule? Because all of Washington are corporate insiders. They're all.
Look, you passed a rule under the Trump administration to increase corporate contributions by tenfold for congressmen and senators when they go out campaigning and they want funds. Corporations can now contribute 10 times more than they could before to those corporate donation coffers. So look, Wall Street owns Congress in terms of every shape, form, and fashion. And look, who writes the bills? You think congressmen and senators are sitting around in their office writing a bill? No, these bills are written by lobbyists. They're sent up to Congress, and Congress says, "Oh, sounds like a good bill. We'll pass it." Look, that's just the way, and that's not a hit on Congress. That's not a hit on politicians. That's just the way it works, right? Just understand how things work. But this is why we keep coming up with these great ideas. Look, socialism sounds great on the surface, right? Helping everybody out, helping the poor people, keeping people in homes they can't afford. We understand. We want to try to avoid the pain. It sounds great. It sounds fantastic. All the things that we're doing with our education system and healthcare system, these all sound great. I spent a decade of my life living in other countries. I have seen firsthand how socialism works. And in every other country in the world, you hear these people on the media, and there's, well, you know, they have social health care in Europe. It sounds great. You know, they have two healthcare systems in Europe. They have one for everybody, which is terrible. And then they have a private system for people with money. That's the one people go to because that's where you get good healthcare. You know where else they go? They fly to the US for health. And so, you know, the point is that socialistic structures sound fantastic on the surface. They don't work because it drives everything to the lowest common denominator. Look, there's a great thing going on with our education system right now, right? Even the AMA is now promoting this idea of equality of education over meritocracy. Think about that for a moment. I don't want doctors coming out of medical school that are the top of their class. I want equal doctors coming out of medical schools. So you're going to go to a doctor that is equal to every other doctor on the planet in terms of education. What type of quality of service you're going to get? Because whenever you want equality of anything, you drive everything down to the lowest common denominator. That's the only way you can make things equal. That's why socialism in socialistic countries, everybody is poor, and there's the very small percentage of the top that have all the wealth and the control. That's what is happening now. These are the policies that we're doing, trying to help a very small fraction of the economy that every economy always has, no matter what system you're in, capitalism, communism, socialism, you always have the poor population. You can't fix that. It's just part of the statistical bell curve of a population. You can either have a very well distributed bell curve of poor, middle class, and wealthy, as you do in a capitalistic system, or you can have a bell curve that's slanted to one side where you have a mass majority of poor and a little bit of rich people. That's socialism and communism. Pick which one you want.
Well, on that depressing note, I think you can actually go on YouTube. You can actually go on YouTube now and do your own gallbladder surgery. So I don't need a doctor anymore. I got YouTube.
Fantastic. That and WebMD. Hold on, Richard. We're going to give away a mug.
Oh, okay, great. Who's going to get one? So
Daniel Dallacasa, we're going to give a mug away. So congrats. You expect one. He's also had a couple questions, Rich, and wanted to know about after you convert a Roth, what the tax implications are for beneficiaries. Do they pay marginal income tax for Roth proceeds due to a death of a Roth participant?
Well, see, what's great about Roth, now, what people don't realize is if I have a non-spouse beneficiary, like I do on my daughter, on my IRA, she's my beneficiary. If I pass away, or when I do, she gets to have to take that money out of that tax-deferred account over 10 years. She's 22 years old, not on her life expectancy anymore. It has to come out over a 10-year period. So think about the tax implications and tax-deferred wealth going out the window. If I convert it to Roth, she has to do the same. She has to take it out over 10 years, but guess what? It's all tax-free to her. So Roth works really well, I think, for non-spouse beneficiaries especially. So the pain is still there where she has to withdraw it, but it's completely tax-free for her. So I think, and again, you know, some people will say, well, what if your daughter is in the lowest tax bracket? Well, guess what? If she has to take my IRA out over 10 years, she's not going to be in the lowest tax bracket anymore. I'm going to push her up all the way up because it's not over her life expectancy. So why wouldn't I do a Roth even for someone or a child that's in the lowest tax bracket? Because I am in essence going to push her into a new one by truncating my elongated non-spousal beneficiary. Go ahead.
I just wanted to, by the way, you just brought up a great point about investing for children. Let me say something real quick. You were talking about this on the show Friday about Fidelity now coming out with accounts for 13 to 17-year-olds. And so parents can, if you have an account at Fidelity, you can now open up an account for your child. And look, there's two problems with this. Is it a good idea? Absolutely. But here's how this has to work. There's schools regularly have stock investing competitions, and the goal is to try to teach people about how markets work. That doesn't teach people how markets work. That teach people how to gamble. The goal of those one semester classes about the stock market is buy some stocks. Whoever makes the most money by the end of the quarter wins the competition. That teaches you to gamble. So people just buy the crappiest stocks. They buy dollar stocks because that's how you win. That's the game. teaching your child about money and, investing in Roths and these type of things is an awesome idea. But there's three things you've got to teach your children about money first. One is the value of work. Two is the value of charity. Three is the value of savings. And once they learn those values, then you can start teaching them about the value of investing and how to do it properly. And that has to be part of a long-term investment strategy, because again, at that age, it's not about buying and selling anything. You buy them an S&P index fund, and you teach them to save into it every single time they make money. So if they go out and mow the yard and they make $20, the goal is to break that $20 into three pieces. This is how it works for my kids. They have to break their earnings into three pieces. They have to save a third of it. They can spend a third of it on whatever they want to spend it on, and they have to invest a third of it. And by doing that, that keeps them in the ability of moving those things forward. And they have to do charitable work. They have to contribute to charities. They have to do these things. They have to learn the value of giving back for the things that they're getting as well. And so if we start teaching our children the true value of work, the moral and ethical value of work, and teaching them the real value of money, then that will lead them to a better outcome longer term. The biggest problem that teenagers have today is their parents gave them everything, and so they don't have any understanding of what the value of money is. My kids both work. They're both 17 years old. Actually, my daughter just turned 18, but they both work, and they pay for their own cars. They pay for their own insurance, and they bitch at me about it constantly because their friends don't have to, and they don't have any money in the bank because it all goes to their car note or whatever it is. That's not my bad. I just tell them, hey, guess what? Welcome to adulthood. But they're going to be prepared when they go out into the world to understand how money works.
All right. So, hey guys,
your kid.
So we usually do a tight stop at right at 9 a.m. We're going to go just a tad bit over. So I want to address two things. So Lance.
Yes.
Big question. So on 2 minutes on gold and crypto, right? Crypto has seemed to take in the place for a minute as the safe haven. Now, this week has probably changed that game, right? As institutional investors are moving out of it and back to gold. What's the forecast there? What does that look like?
Look, crypto is an interesting thing, but ultimately there's three things that are going to define the outcome of cryptocurrency. The first is that the IRS is going to start taxing you and tracking those cryptocurrencies. That was a headline out last week. Government is going to start regulating cryptocurrencies because they have to be able to track where money is flowing in the economy. And look, a lot of the money in cryptocurrency is being used for illicit purposes. The third thing is that ultimately there will be no other cryptocurrency. There's a reason that you can't print dollar bills in your basement, right? It's called counterfeiting. And there's only one legal tender. And the government has to control the flow of money in the system. It is a national security issue. Right? If people are just manufacturing dollars in their basement, I can send them out to a whole variety of nefarious purposes that may not be good for the economy. And two, we talked about the reserve currency status of the country, which is crucially important. And that has to do with control of liquidity of the currency to keep it balanced relative to other currencies. That's how we conduct business. So eventually the government, when cryptocurrency becomes a threat to national security, the economy, and to liquidity and flow and tracking of money, the U.S. government will step in and say there is only one cryptocurrency. We've been moving to digital currency for years. Everybody's using credit cards and debit cards now. But eventually the government will say there will be only one digital currency. It will be the U.S. dollar digital currency, and that's the only one you can use or transact business in. Everything else is now illegal. And that's just a function of what will happen. That may be 5 years from now, maybe 10 years from now, but that will get there. So in the meantime, though, cryptocurrency is great. It's speculative. Have a good time with it. Just understand what your risk is when you own it, when you buy it. It is not going to replace gold. Gold coins will be here after a nuclear meltdown. So, crypto is great as long as you have power and an internet connection. Gold doesn't require any of those. So if I'm going to buy something for my fallout bunker shelter, I'm buying gold bullion or gold coins for the end of the world, coming zombies. Richard was watching the zombie movie last night. So when zombies come, I want guns, I want lead, and I want some gold. And the reason I want a lot more lead is I can get gold from anybody that's got gold that doesn't have lead. So head to California with your lead, get all the gold you want. So
in the zombie movie last night,
yep,
they are in Las Vegas trying to collect $200 million in a town full of zombies. Like, and I'm thinking, in the zombie apocalypse, is what's the dollar going to be worth?
It's
but
not.
the point is, they're also going to be going for gold. No one talked about going for crypto in Las Vegas.
Yeah, you can't
the zombie apocalypse.
Look, once you lose power, it's over. So, crypto's great until you lose power. But anyway, that's all
right.
Look, trade. You can trade crypto. It's a lot of fun. Trade it. You can make some money with it. Just understand that this is not a replacement for gold. You do not store your savings in it. You cannot store savings in something that moves 30% in a week.
Or for fiat currency.
Yeah.
Well, Lance, right? Come up with rules. Come up with rules that if you want to speculate, right, know how much you're willing to lose. If you want to dip your toe in this water, it's okay. I guide people all the time. As long as you're willing to look at it for what it is and have rules around it, and not mortgage your home for it, and you're okay.
Yeah. So, look, full disclosure. I talked about this on the show on Thursday with Michael Leibowitz. Right. I own Bitcoin. I own Ethereum. The way I study and the way I learn markets is by trading in them. Right. So I own two coins, two types of cryptocurrency because I want to learn how the market works. I'm trying to learn how this works long time. Is it a viable asset class? Does it become part of our investment structure and portfolios at some point down the road? I'm spending a year to determine that, but it's an interesting process along the way.
Yeah, for sure. So, hey, we're almost out of time. I want to get to one question that seems to be a pretty common question, at least as of right now. So, Lance, describe the process. So, as markets are at this all-time high, what's the process look like from a portfolio management standpoint on protecting assets, mitigating risk? When we do see, we shift from that bull to bear.
Right. So, there's three different levels of indicators that we follow. So, if you watch our 3 minutes on markets and money that we put out during the week, if you go to our website, realinvestmentadvice.com, click on the YouTube channel, subscribe to our YouTube channel, right? We publish videos every day, but every day I put out a 3 minutes on markets and money. We talk about our money flow indicators. We talk about our other technical indicators. But those run in three levels, right? We have a short-term view, which is, hey, you know what? Right now, we don't want to put money to work here because markets are on a sell signal on a daily basis. Prices are probably either consolidate or contract here a bit. And when that happens on a short-term basis, we can add a little bit more money to the markets. Then there's the weekly indicators. These are much more important about determining when market trends are changing. When back in February of 2020, the reason that we cut exposure by 50% in our portfolios back in February of 2020 was because our weekly indicators said, hey, something's going on here in the markets. Don't know what it is, but something's happening. We need to start reducing risk. And so those indicators got us out before the actual crash of the market occurred. You will get out potentially a little bit early, a little bit late. You might get in a little early, a little bit late. Because the crash was so swift in March of 2020, it took almost a month and a half before our indicators finally turned back up. So we were late getting back into the markets in 2020, but we bypassed a vast portion of that sell-off in the markets because of the reduction to risk. So and monthly indicators tell us that even on a longer term basis. And as I was showing you that chart earlier, our monthly indicators tell us that, look, outcomes for markets over the next 5-6 years are not going to be good. But that doesn't mean today. That doesn't mean tomorrow, next week. So you have to marry these ranges of technical structures and price dynamics to understand when to increase risk, when to reduce risk, and when to just rebalance portfolios, even just small measures. We spend a lot of time in our portfolios just tweaking things here, trimming off some profits over here, adding a little bit more to positions over here. And that helps us to keep the portfolio stable and growing over time.
Great. Thank you, Lance. So, hey, we're going to give away one more mug. Stephen Oden, thank you for joining us today. And hey, thank you all of us and Lance for joining us on Candid Coffee. This is typically Rich and I talking about planning topics, things of that nature, but we understand how important the investment aspect is. And, blessed to have Lance with us today. You guys have been an awesome audience today. Lots of great questions. If you have more questions, don't hesitate to go to realinvestmentadvice.com, ask them there. We'll be happy to answer them. Also, please complete the survey. Let us know what you'd like to hear more about. We'll try to get some more of these questions throughout the week on the show. We're also doing some quick videos on your Q&As. So We're going to be getting those out. You can go to the YouTube channel, The Real Investment Show. If you'd like to schedule a meeting to learn more about what we do, how we do it, you'll be able to do so in the survey. Also go to realinvestmentadvice.com. You can schedule one right there. We'd love to hear from you. Love to help you any way that we can. And thank you guys for spending Saturday morning with us.
Thanks. Bye.
Thanks, guys. Everybody have a good weekend.